Let's make sure we're recording. Okay. Greetings and welcome everybody to today's webinar. I'm your host and moderator today, the bright and shiny Jeff Sandine. When I'm not surrounded by technology and glowing on webinars, I'm a certified financial planner and president of Sandine Strategies. I'm also founder of Business Pros, the producer of today's webinar, which is titled Uncovering Hidden Cash Flows Within Your Business. It features Brad and Lindsay Pollock. I'll give you more detailed introductions of them prior to their presentations. Business Pros is an alliance of business professionals collaborating to bring high quality educational content to entrepreneurs, business owners, and executives, as well as helping each other's business development efforts. Here's how today's webinar will be structured. Brad and Lindsay will each make 18-minute presentations. During these presentations, if you have a question, type it into the chat box. The chat function is displayed when you move your cursor over the Zoom screen, and you'll see the chat icon down at the bottom. We'll answer any chat questions put in there at the end of each presentation, and then we'll also have open Q&A after both presentations are completed. During this session, there'll be 3 polling questions. So for CPAs seeking CPE credit, this webinar, for them seeking credit, they'll have to answer all 3 questions to verify their attendance, but we promise not to grade your answers. Lastly, a link to the recording of this webinar will be emailed to all people registered in the next couple days. So with all that in the background, let's proceed. As everyone knows, business has been disrupted on an unprecedented scale this year. In response, the U.S. Treasury and Federal Reserve Bank have implemented trillions of dollars in economic stimulus, including PPP, EIDL, and a Main Street lending program. The stimulus money provided a very necessary bridge for many small and medium-sized businesses. As companies get back to a semblance of normal, their focus should return to tightening up their operations while the economy repairs itself. While most companies do a good job managing their core expenses, many leave meaningful dollars on the table with their supplier base and often fail to fully leverage available federal and state tax credits and incentives. Our objective today is to show you how much money is available, where it is, and what steps companies need to take to drive incremental savings and cash flow into their business. Our first speaker today is Brad, Principal Consultant with Expense Reduction Analysts. Brad has 30 years of strategic business, financial management, and operations experience in the C-suite of middle market companies and large divisions of Fortune 500 companies. His financial experience spans diverse industries with a focus on cost savings, indirect taxes, and process improvement. Brad's a CPA and an active member of the Financial Executives Institute. Okay, Brad, I'm going to unshare my screen now and you can get set up. Ladies and gentlemen, Brad, take it away. Oh, you have to unmute yourself. Try it one more time, Brad.
Okay, Jeff, is that good?
There you go. There you go.
Okay. Well, thank you, Jeff, for the kind introduction, and welcome everybody to today's webinar. I'm excited to be here today. I want to provide you a little bit more about ERA and myself, so you have a little bit of perspective of what my perspective is on this topic. At ERA, we partner with C-suite executives to help drive cost reduction in various different cost categories where our clients may not have the resources or the expertise to fully optimize and drive savings. The end goal here is to help drive these savings so companies can actually deploy the incremental cash in much more strategic manner in their business rather than just paying another supplier invoice. So Jeff mentioned, I am a CPA and have served as an operating executive as both a CFO and a COO of various enterprises. So I have a very good perspective and appreciation for cash flow, positive cash flow, that is, and working capital. You know, as a CFO, I always thought I did a pretty good job managing costs. I hired smart people. I surrounded myself with high-performing teams, and we were successful. But it wasn't until I started spending 100% of my time focused on cost management did I realize how much I personally was leaving on the table with suppliers. And the opportunity here is quite immense, and I'm happy to share some things with you today that hopefully you'll be able to deploy. Now, as Jeff mentioned, we certainly are living in interesting times right now, and there's no playbook for the COVID-19 environment we're living in. Companies are subject to a lot of risk right now, and frankly, a lot of them are making some very decisive actions that we've seen, whether it be furloughs, hiring freezes, elimination of travel, discretionary spend, even deferring strategic investments that they had planned. So these are important in today's economic climate, but they aren't sustainable in many respects. And in the whole world of supply chain, it's a pretty broad topic, but I'd like to cover today and address my comments more specifically around how to improve supplier relationships and how you may some tools and tips that you can deploy in your business to actually drive incremental savings. I also kind of spend a little bit of time describing some misconceptions that are out there that limit people's success in this effort. So I have 15 to 18 minutes here that I'm going to kind of go through some slides, and then we'll open it up for some questions, and I hope you'll be able to find this beneficial to you. So I always like to start a conversation off with a little bit of humor. Many of you may know about the Dilbert comic. I read it all the time, and I felt this was a very applicable to our discussion today. You know, here Dilbert is surprised to learn that through a conversation with the supplier that the prices are intentionally confusing. Surprise. There may be a little bit of truth in that statement, but I found this quite funny. But at the end of the day, it begs the question, are you as a business operating on a level playing field with suppliers? And I'd like to help you get there if you're not. So I'm going to move to my next slide here. Second. So let's start with the why. Why do companies leave money on the table? Well, there's many different reasons. I'd like to focus on 4 in particular because I see these all the time. Well, number one, there's too doggone many suppliers out there. Companies have hundreds, if not thousands, of suppliers that they work with all the time. And there's challenges. They're challenged to get visibility into their spend and really dive into the specifics of so many suppliers. And it's not easy to obtain. Not to mention that there's always a lot and many internal stakeholders that interject themselves into the buying process. A lot of times you need their input, but sometimes it's like herding cats. It's certainly not easy. Number 2 is a lack of benchmark information. Ideally, you would want to know what other companies are paying for the same or similar product or service, or how else would you know that you're truly optimized in your supplier negotiation? Now, the challenge is that information isn't readily available. People don't share what they pay readily with other companies, for example. But there are some resources available that I would like to share with you. One is Procurement IQ, and another one is Spend Matters. And I'll have a reference to these in the resources at the end of my presentation here. But these are resources that provide you lots of economics and drivers within a particular category or many different categories, and some good information to ask suppliers when you're going through a negotiation. I'm very impressed with these and use them quite often. Limited expertise. Now let's be real. Nobody can be an expert in every category. And with so many categories, oftentimes supplier agreements are accomplished as side of the desk projects for managers. There's just simply not enough resources to be an expert in every category. And there becomes a practical limit to what a company can achieve in negotiating with suppliers. But unless you're able to leverage some of these resources that I mentioned. Now, culture. Culture is always a big one, and it's so important in a business. But does your company care about cost management? Is your CEO and your CFO involved? Do they participate? My bet is your company, or many companies, are having and recognizing your top salespeople all the time. But do you recognize employees for their efforts in cost management? Is this something that is at a minimum recognized so that people have a feeling of participation, and the overall company is culture is more focused on trying to run an effective and controlled cost effort? So have you heard these types of comments before? My bet is you have. That's the way we've always done it. It's too late to turn back now. Oh, we're too swamped to do that. We don't have any time to focus on this. One of my favorites, we're different, that won't work here. A friend of mine named Jack Quarles, he wrote a book, and it's entitled Expensive Sentences. And I would encourage you to consider this as a good read. In fact, I share it with my clients oftentimes because it really gets to the heart of a culture and to what companies are faced with, and how you just can't tolerate these type of expenses, sentences, if you will. Jack coins it, is that these type of sentences do two things, and they're both not good. They steal choice and they limit possibility. So I would just encourage you to continue to promote a culture of cost management and inclusiveness. So, whoops, one second, get back here. So where is the opportunity? Listed here are lots of different indirect overhead expense categories. And you know, the Pareto principle, the old 80-20 rule, certainly does or is applicable to this situation. In most companies, 80% of the spend is in 20% of the suppliers. Now, leaving 20% of the spend in 80% of the suppliers. Now, as you would expect, companies are focused on their strategically managed high dollar spend categories. They hire people, specialists as employees, to focus on those areas, as they should. But this leaves this whole tail of spend out there. And for many companies, it goes unmanaged for many of the reasons I described earlier. And there's been just a tremendous opportunity here to actually achieve additional savings for a company. So let's pause here for a brief exercise. Think about your company right now, and think about what are you spending in some of these categories, in freight, for example, or telecom, or copiers, or merchant card fees. And when was the last time you truly benchmarked that spend to see if you were being fully optimized? Would 10 to 30% savings in these categories be of meaningful dollar to you? And Brad, where did you come up with 10 to 30%? because certainly it's not in every single category that you can, you could be, optimized already. But in our 25 years of history working with clients, this is the average that, we, for our successful projects, find with our clients. So we know it's there, and it can be quite impactful on a business. Let's do the math for a moment. Imagine if you're a company with a 20% profit margin. A $300,000 savings in an aggregate in several of these categories could be equivalent to $1.5 million in sales revenue. So that's quite substantial. I know a few salespeople and business executives that would be pretty darn excited to achieve a $1.5 million sales order. So I just submit to you that it makes a whole lot of sense to spend some time in this area, considering the tremendously high ROI. Plus, when you are achieving sustainable savings and monitoring the savings, you have just increased your EBITDA, which is so important in today's world, and your forecasted cash flows will ultimately impact your market cap. So it certainly does get a lot of people's attention when you truly put your cost management hat on, for sure. Okay. So who has the advantage in a supplier and a buyer's relationship? It's an interesting question. I guess it depends, but the general construct of that type of a relationship naturally favors the supplier in the sense because they have all the access to the information about their product and services. However, when you change the paradigm a bit and you become a more informed buyer of the services, how? By leveraging some of these resources that I've shared with you and just through some experience, you start leveling the playing field. And when you level the playing field, the suppliers take you very seriously, and you can truly optimize supplier agreements and be better and achieve better results. When you think about a supplier, what motivates them and what's on their mind? Because you don't always want to think about the we, right? If you think about suppliers, of course, their primary goal is to win business at the highest margin possible. They're all in a business to make money as well. And they've been challenged in this environment, just like you and everybody else has. But they price their products and services based upon the customer information that they have available. So it's okay to share information with suppliers. It's okay to talk about your requirements in detail, your volume needs, what's going on in your business. Because the more that they understand your business, the less risk they take. And when they take less risk, they aren't required, they can be more competitive with their pricing, and there's a less of a chance that there would be an embedded risk premium embedded into the pricing or the quotes that you receive. On the cost side of the equation, suppliers are spending a whole lot of time and technology to help lower their cost of service delivery. And they provide a lot of portals, applications, free services, training, whatever it may be, to lower their cost. If they're able to lower their costs, their margins are better. So my question to you is, are you taking advantage of all these supplier-provided technology and applications? Or are you placing constraints on the suppliers or falling into the challenge of this is the way we've always done it, and not being so open to perhaps changing a process or considering other products or services by your suppliers? Because folks, suppliers know how to reduce your costs, and yet so many companies really fail to ask. And I was raised, if you don't ask, you don't get. So I think that's a very important part wanted to highlight. So when you invest the time to become an informed buyer and follow a disciplined approach, you will certainly enjoy much better success with leveraging and optimizing your supplier agreements. Let's see. Polling question time for our CPAs. Who said this quote? "The bitterness of poor quality remains long after the sweetness of low price is forgotten." Just respond in your chat, A, B, or C. This is a picture of a quote that I saw in one of my clients' manufacturing facilities, and I loved it. And so I took it, and now I'm using it now. I just think it's a great one. So who did this? Who said this? If I had the Jeopardy music, I'd be playing it right now. Ben Franklin, of all people. Not Gordon Gekko. He was the greed is good, if you remember. Okay, moving right along. Common procurement misconceptions. Now, I wrote an article that I would be happy to share with the group entitled, "What Suppliers Don't Want You to Know." And it goes through all these in a little bit more detail. It's available either on my LinkedIn, or I can email it to anybody who'd like, or I can after the session. But so many times people think they're doing an effective negotiation style or process, and they're not necessarily. There's several here. I'm not going to go over each one, but I would like to provide an example or two. One of my favorites is number 4. Supplier loyalty translates to best price and service. Now, cultivating a relationship with the supplier is very important, of course, and having a good working relationship. But please don't overlook the importance of evaluating suppliers on a periodic basis, because it may cost you more than you think. I mean, the old adage, "Inspect what you expect," is so appropriate here. Perhaps an example would be good here. There was a company that had a long-term relationship with this printing company, or a printing supplier. They were very, very happy with the supplier. The service was fantastic. The quality was there. Very good relationship. I guess the occasional lunches and ball game tickets didn't hurt either. But the board challenged the management team to take a harder look at some supplier agreements. And after interviewing and going through the process, or interviewing other suppliers, they realized that they were paying above market rates, and realizing that technological advances had really reduced the cost of delivery for these printing companies. Yet those cost savings had not been passed on to the buyer or to the company. So needless to say, there was a change in suppliers in this instance, and the company has much more favorable terms with an alternative supplier. Now, it's always a good idea to separate the internal relationship, person with a relationship, to the one that's negotiating it with the suppliers. If you can kind of put up that Chinese wall and have a much more effective way, independent discussion, you're always better suited to achieve results. And the fact of the matter is, you don't have to do all these things all at once. You can start a program where you're looking at maybe 3, 4, 5 categories a quarter. I mean, that's at least a start. I mean, the savings can be pretty substantial. Another misconception is getting 3 bids gets you the best price. Now, I've just seen so many times where companies have a policy that they have to go at least 2, if not 3 bids before they buy something. My question is, how often is this really more form over substance to drive savings and drive the best price for the company? This doesn't always result in a lower price or a better deal. You have to ask the right questions, and you have to be disclosing your requirements of what you want, and ask the right and important questions. You know, ask for rebates and incentives and caps on future price increases, et cetera. Those are all important as you go through, the process. So anyways, again, I had this article that I had shared, I'll be sharing with you guys, that might be a good topic to share and discuss at a potential staff meeting. Okay, so here's a roadmap you can use. It really kind of pulls everything together. I wanted to highlight number 2 here in particular. Analyze and validate your purchase history. I can assure you it's not what you think it is. I have witnessed many times very surprised looks on the face of the C-suite executive when we sit down and we review spend history and look through some of the analytics of pricing and average price cost and whatever the scenario is when you're looking at the spend analysis. And there's so many things you can do internally even to tweak these processes to achieve really good results. By doing this exercise, you highlight a few things. Disproportionate supplier spend patterns, off-contract pricing, and occasionally you'll run into supplier pricing errors that you can go back and get refunds on or credit for. So again, it's like that elephant. How do you eat an elephant? It's one bite at a time. And this is certainly a area where I think you could, really drive savings. I've seen some incredible results by companies, especially during this time when they really need the cash. So resources. So here are a few for you to that I want to reference. Here's the short article I've written, What Suppliers Don't Want You to Know. I also host a LinkedIn group called Cost Optimization Forum for Executives. And if you're interested in this topic further, I would encourage you to join the LinkedIn group. I do share information and trends in the industry and tips and things that my company ERA posts as well. Here's the link to the Expensive Sentences book by Jack Quarles, a very good book. And then a summary of the 2 companies that provide the procurement market intelligence. And you'll be amazed what you can glean from some of their resources. And then finally, expense reduction analysts, we're a global consulting firm. And so we have more white papers and more industry specific information than you could deal with, quite frankly, but it's available. I would encourage you to check our website out if you have an interest. So, Jeff, that concludes my prepared remarks, and I'm happy to take some questions if there are some, or we could just do it towards the end.
Right now, there's no questions in chat, so thank you, Brad, and we will get back to you in the Q&A segment.
Okay.
Let me reshare my screen. Here we go with polling question number 2. In the movie The Big Short, the cause of the 2008-2009 Great Financial Crisis was depicted to originate with which of the following? A, an undercapitalized casino industry. B, overleveraged mortgage bonds and derivative securities. Or C, a blue butterfly flapping its wings at the Amazon River.
You had fun with that.
So CPAs, we're not trying to make this difficult. We just want to make sure you're still here, right? So type your answers into the chat. Next up, we have Lindsay Pollock. partner with Tax Credit Collective. Lindsay's worked with small to medium-sized businesses in DFW since 2000. With a background in public accounting, she understands the importance of helping increase business profitability on both the top and bottom line. Lindsay has a passion for networking, connecting people, and public speaking. She partners with CPAs and helps small and medium-sized business improve their cash flow by uncovering specialized tax credits that were previously missed or underclaimed. Lindsay, I'm going to share my screen now, and you can get yourself set up.
All right, can you hear me okay?
Yep. Do you want to put it in presentation? There you go. All right, Lindsay, take it away.
All right. Well, I'm here from Tax Credit Collective. I'm a partner here in the Dallas area of this locally owned firm. And I want to talk with you guys about a particular tax credit to help bring cash in a time of crisis. If we've ever seen businesses in time of crisis, it sure is right now. And we're seeing businesses that need cash more than ever. So to that end, what I plan to do is to walk you through the basics of qualifying a business's activities and expenditures for the R&D credit, give you a case study example of how Tax Credit Collective works with businesses, and answer some specific questions related to this particular credit today. So I'm going to give you a few facts to start our discussion. First fact, there are 30 million businesses registered to do business in the US. Of those, 99% are considered small to mid-sized businesses, being that they receive less than $50 million in annual revenue, and they have fewer than 100 employees. Second fact, the government issues $100 billion with a capital B dollars in annual incentives to businesses, but 80 billion of those incentives go to the Fortune 500s, leaving 20 billion left over, and most of those go to the top quarter of 1% of businesses. Big business is getting most of the tax incentives out there, is what I want you to take away. And of the most lucrative tax credit, the R&D tax credit, $15 billion are claimed in this tax credit, and they're claimed by 16,000 companies each year. Now, companies that do $250 million in revenue, according to the Treasury, claim this credit 91% of the time when they're eligible. When you contrast that with smaller businesses, those that are under $50 million in gross receipts, they claim the credit only 12% of the time when they're eligible. There's a huge disparity between big business and small business. And I would venture that there's no difference in what they do on a day-to-day basis. Smaller businesses simply don't have the resources and the infrastructure to go after these tax incentives. So, what am I here for? Tax Credit Collective lives to fix that statistic. We eat, sleep, and breathe tax credits, and we want to get them into the hands of small to mid-sized businesses. Who we are. We serve companies in manufacturing, in technology, in architecture and engineering, in construction, oil and gas, and in agriculture primarily. So let's talk about this credit specifically, the R&D tax credit. I want to walk you through, qualification using the four-part test from IRC 41. IRC 41 states in a four-part test that a business must be making or seeking to improve a qualified business component. What's that? That's going to be a product, a process, formula, invention, software, or technique. They're going to want to make improvements to that in terms of qualitative improvements. These are not aesthetic improvements. These are improvements in terms of functionality, reliability, performance, or speed. When they make these improvements, the second part of the test states, or when they want to make these improvements, they don't even have to succeed. Failed R&D is great R&D. When they make these improvements, there's going to be some level of uncertainty or doubt. Now, if you ask an engineer, do you have any doubt? He's always going to say, no, I have no doubt. We can always achieve this. But what we need to prove for the purposes of the credit is that there is doubt in terms of one, capability, Can we do what we're tasked to do by our client or what we're trying to do? Number 2, methodology. How are we going to do this? Or number 3, what we most often prove in our business is final design. What is the final design going to be when we roll it out to the marketplace, when we sell it on the app store, when we present it to our client, when we launch it in the marketplace? Well, we don't know. So number 3, we're going to go through some sort of process of experimentation. This process of experimentation is going to be a systematic evaluation of alternatives aimed at achieving a result. It could be as simple as evaluating prototype A and prototype B, trials and a trial and error, modeling, alpha testing, beta testing, debugging code. It could be as complex as the scientific method. But as long as that process of experimentation relies on a hard science, test 4, it must be technological in nature. So the process of experimentation is going to rely on physical science, biological science, computer science, or engineering. These are specifically mentioned in the tax code. And if the business goes through these 4 parts, they have now met the 4-part test to capture the R&D credit. This is talking about qualification of activities. Feel free while I'm talking, if you've got questions, chat them to me or to the whole group, and I'll get to them at the end as we go through this. All right, so what does this actually look like on a day-to-day basis? This looks like a business going through multiple iterations, designs, code revisions, red lines, blueprints, or schematics. They're incorporating or developing new technologies, perhaps, to catch up to their competitors in the marketplace. They're attempting to develop or improve a product or process. Maybe they even eventually abandon the attempt altogether, but they do try. They're implementing new manufacturing processes. Recently, manufacturing processes were included in the process of experimentation, and we can capture those in the manufacturing space. Or maybe they're bringing in improvements to testing or quality control. Perhaps a customer comes to them and they want them to develop a new product, and they have some sort of technical doubt where they have to satisfy the customer's requirements. Or maybe it's just using your know-how, and maybe you treat it as a trade secret or something that's patentable. What are some general qualifying activities? I get asked this a lot. I have lists of hundreds of qualifying activities, but these are just some basic ones. Concept development, feasibility evaluation, specification design, experimental prototypes development, design test and execution, design refinement, beta testing, prototypes refinement, technical design reviews, technical meetings, technical writings, compiling research data, preparing research documentation, direct supervision, or direct support of research. And we'll get to that a bit more in a moment. You see, all these things have to do with technical stuff. I look for technical people on staff. I call them a TED, not a Ted Danson or a Ted Nugent, but a TEDD, a technical person, an engineer, a designer, or a developer. All right, so we've qualified the activities, but what about quantification? How is this thing made up? Why am I skipping? This comes from salaries and wages, the Box 1 W-2 wages of the people involved in the experimentation, the people directly supervising the experimentation, and the people directly supporting the experimentation. Our next box comes from contractors, 1099s that are involved in this process. We can allocate 65% of qualified spend on contractors. Our next box is supplies and materials. These are supplies that are used or consumed in the process of experimentation. These are non-depreciable in the hands of the taxpayer. And last but not least is the lease or the rental cost of computers that are used in this process. This comes from something old in the tax code where we used to have computers that filled a room and could be leased. Now this looks more like Amazon Web Servers or Google Web Storage space, which can be a big expense in the software development space. All right, so WIFM, what's in it for me as the taxpayer, as the client? Well, here's a simple sample calculation. The calculation is much more complicated than this, but just for some easy math, if you've got $100,000 in qualifying research expenditures per year, we're limited to capturing 50% of those. The federal gross credit is 20%, and after we take our limitation, this comes out to about $80,000 or 8 cents on the dollar of qualified spend on the federal side. This is a tax credit. This is not a deduction. A tax credit is a dollar for dollar offset of tax liability. So it's much better than a deduction. And in addition to that federal 8-cent credit, there are state credits that piggyback on top of the federal credit that in some states make it double of what it originally was. So this is a very lucrative credit. How far can we go back? We can look back up to 3 open tax years, and we can carry this credit forward up to 20 years. If tax has not been assessed in the prior 3 years, we can look back further than 3 years. Statutory deadlines apply to this whole process. So as an example, because the timely filed deadline for April 15th got moved to July 15th, we're now finishing calculations for taxpayers who had qualifying activities in 2016 that normally would have expired on April 15th of this year, but we were able to grab those expenditures because we now have until July 15th to get the 2016 returns amended. So that's providing additional cash to businesses right now using that extension of the deadline. Documentation requirements. IRS is going to want to see something to prove this up. So the tax regs say that a taxpayer must retain records in sufficiently usable form and detail to substantiate that the expenditures claimed are eligible for the credit. That is not very specific. And so what we actually look for in practicality are 2 different types of documentation to prove up a claim. Number one, the first type of documentation is going to give us an allocation of time spent. This is stuff that puts people and things on a qualified project at a particular time and place. What's that going to look like? Internal things like meeting minutes, emails, notes, calendar invites, client-related info such as project proposals and contracts. We're going to evaluate purchase orders for materials, project costing, maybe employee tracking or payroll data. That's going to help us with the time that's spent. And then the second types of documentation are going to be stuff that qualifies the activity. Does the project or the activity meet the 4-part test? This is where we're looking at napkins with designs on napkins or legal pads with notes, calculations and designs, testing results, internal review documents, maybe marketing information that a company has put out there, release notes or manuals, white papers that they've published, or maybe something that they've released at a technical conference, something on their website. We're going to be looking at all types of documentation to gather this up and to prove up this claim. You might think, oh gosh, I don't have white papers and I don't have things like that, but you're going to have projects, you're going to have proposals, you're going to have contracts with your clients and purchase orders. So you are going to have a good deal of documentation already available. There are special forms for filing this. On the federal side, it's Form 6765, and then each state has its own type of form and requirements. Polling question. In the movie The Wolf of Wall Street, Leonardo DiCaprio played Jordan Belfort. As he shelled out $100 bills on his boat to the federal agent, what did he call them? A, dollar bills, B, fun coupons, or C, Benjamins? If you'll chat those, that would be great. Dollar bills, fun coupons, or Benjamins? See the chat real quick. Yeah, you guys know your movies. It is fun coupons. All right, next. Here's a bit of a bonus for you. Use of the general business credits against AMT is no longer restricted if the company is an eligible small business. If you're trying to offset AMT, what's an eligible small business? Well, starting at the end of 2015, an eligible small business is a non-public entity, and it has average annual gross receipts for the preceding 3 years for less than $50 million a year. Of course, after January of 2018, corporate AMT is effectively eliminated, but there you have it. Here's another little bonus for you. These credits, these tax credits, can be applied against payroll taxes. That's your OASDI or your FICA if your company is a qualified small business. What's a qualified small business? That's a corporation or a partnership that has gross receipts of less than $5 million average per year and has had no gross receipts for more than 5 years prior to the current tax year. Where does this apply? This applies with startups quite a bit, especially in the tech space. They're paying people to develop a platform or a product, and they may not be paying federal taxes yet because they're not profitable, but they do have payroll taxes. And so we can take this credit and offset their payroll taxes, which are 6.2% annually. We can specify the amount of the election toward this payroll credit. We can take some of it toward payroll, we can take some of it toward federal taxes, but this can only be elected on a timely filed original return. We cannot amend for this anymore. So if this is going to get elected, it's got to be done before it's timely filed. And control group rules apply. What does the story look like when somebody comes to us? Well, we gather information during intake, we request more information, and that's custom tailored based on that client's unique circumstances and facts. We kick off our study while reviewing the phases of our engagement. We lay out our roadmap for success. We schedule meetings with qualified people in the business to figure out what we need. How do we lay out a study? Our studies are laid out in 3 phases. Before we ever engage with a client, though, we want to make sure that this is a good use of everybody's time. Our goal is that there's no wasted client time. So we're going to identify 4 key metrics for good fit before we ever engage with somebody. The first thing is the TEDs. They've got to have some technical people on staff, some engineers, some designers or developers that are doing the stuff and things that we think they should be doing. Next, usability. Tax credits are wonderful, but if you can't use them because you don't owe taxes and you're not profitable, even though you can carry them forward, you're probably not going to want to have someone like us go capture them for you until you can actually use them. And benefit. Who's going to benefit from these tax credits? Is the entity set up in such a way that that person is able to actually take these credits and benefit from them? The credits flow through to where the entity pays taxes. So if this is a flow through, the owners of the entity are going to personally benefit from the credits. If it's a C Corp, the corporation itself is going to receive the credits. And then the last question before we engage is statutory deadlines. Have we passed them already? Are they coming up quickly? Where are we sitting and what can we capture based on deadlines? So if we do engage with a client, our first phase is that we really want to get to exactly how many credits are available, and are there any study killers, red flags, or showstoppers that are going to keep this from being a successful use of everybody's time. The first phase of every engagement is on our dime. We will do a phase 1, which generally takes us about 20 hours of our time, and it takes the client about 1 to 2 hours of their time if we feel like this is a good use of our time, because we think there's going to be credits there that they're going to be able to use. So we'll do phase 1 on our dime to figure out what's there for them to get to. Come into phase 2. Phase 2 is where we fully document everything that's needed to substantiate and prove up this credit. That's done by interviews with the TEDs that are on staff and by gathering documentation. That generally takes 6 to 8 hours of our client's organizational time. And if we can't get to about $10,000 per organizational hour of their time, it may not be a good use of their time, or maybe. It's up to our clients to decide that. A bit of a differentiator between us and some other folks out there in this space is that we will not move to phase 2 of an engagement unless both parties mutually agree that it's a good use of our time and that we actually want to do that. If we get to the end of phase 1 and for some reason there's not enough credits, or it just doesn't look like a good thing to do, we will walk away, no harm, no foul. Phase 3 of this process is where we help our clients claim this credit on a year-over-year basis, because this is a permanent credit. It's not going away. Additionally, if this is ever to get looked at or questioned, we will defend this credit tooth and nail under audit and appeal. I'm going to open this up for any questions. I'm going to check the chat real quick to see if there's anything sitting out there.
Brad asked a question, but it looks like, I think you just answered it about the permanency of the tax credits.
Yes, this R&D credit was introduced first in 1981, and it was made permanent in 2015. So I no longer have to wonder if I have a job every year.
Awesome. Well, there's no other questions in chat, so why don't you unshare your screen, and we'll open it up to questions to either of you. So attendees, if you have a question, type it into chat and let us know who you're directing your question to. While you're thinking of questions, I'm going to ask one question of each panelist. My first one is for Brad. You have to unmute yourself, Brad. There you go. Businesses are challenged in the current business environment that includes suppliers and vendors. So how are you advising clients to best manage their suppliers and vendors during this time where they're having difficulties also?
Well, that's an ever-present question in today's environment. You know, companies, we're seeing companies slow pay invoicing to suppliers. That said, I do think suppliers have been more forgiving as it relates to late fees. But I would suggest that from a company standpoint, that you don't ghost suppliers. And if you can make at least one payment and they know what your plans are, and just ask for some forgiveness of some late fees. That's one thing. I will say we have seen an uptick in virtual payment cards or virtual cards, and you know, this is an opportunity for companies to actually pay instead of with actually make your payables department a profit center, because you can actually pay via virtual card. Suppliers get paid timely, and there's rebates available. I heard, I think just last week we had a client that saved $230,000 in just rebates by having their suppliers accept payments on virtual cards. So those are some things that we're seeing. This is a pretty good time, you know, supplier to go out to the market. I mean, RFPs, suppliers and their salespeople and the suppliers want to sell things, and they're actually being very competitive to try to get deals done. So, you know, follow some good process with RFPs, and I think you find some good deals out there. I do think companies have made some changes in their business. Everybody's staying at home, so there could be some unused or underused services that you've already contracted with. Again, call your suppliers, ask for credits or deferments so that they can maybe extensions on the contracts, because you don't want to lose that ability to leverage that. So those are a few.
Awesome, thank you. It's supplier management, right?
Yeah.
So Lindsay, I think I know how you guys get paid. It's probably a performance fee of some sort, but can you go into that in a little bit of detail on how you're rewarded for finding these tax credits?
Sure. We try to be pretty flexible with our clients based on what they need and how they want to structure an agreement. The average agreement with us, however, involves some skin in the game for us. So we typically get paid a percentage, a success-based percentage fee of the net credits that we identify for our clients. I say net because they're going to be counted as income, and we want to be fair about how we're paid.
It's very similar to our practice too.
Cool. So I want to be respectful of everybody's time. So what I'm going to do is ask each of you the same question, and then we'll conclude the Q&A. There's no other questions in the chat box. Start with Brad. Brad, so if there's one single takeaway or indicator that companies could be looking for to know when to engage your services, what might that be?
Well, I think when a company is looking for cash or looking for ways to drive more efficiency in their business with their suppliers, focusing on that tailspin where they may not have the level of expertise in a particular category, that's when they can reach out to us. We're structured much like a law firm where we have specialists in over 40 different categories. And so we're able to really drive some good savings when you're an expert in a category, as I mentioned before. So thank you.
Good. So Lindsay, why don't you answer the same question? It's how does a company know? I mean, the R&D is fairly broad, so it seems like it can just about apply to anybody that's doing research, but how will a company know for sure if it's worth their time to come and engage with you?
More often than not, people seem to self-select out and think that they don't qualify for this credit, even though, like you said, it is pretty broad. They hear the words research and development and they think, I'm not wearing a white lab coat, I'm not in a lab holding a beaker, so I probably don't qualify. But that couldn't be farther from the truth. So I always go back to the 4-part test. If a business is making or improving a product, process, formula, invention, software, or technique, it is generally a good use of our time. And that looks like verticals such as manufacturing, technology, engineering, architecture, construction, where there's a design component, oil and gas, and agriculture.
Yeah, Jeff, I think both Lindsay's firm and mine, we're just open for conversation. And that's how you start a dialogue, is because in our businesses that we do, we're not selling a pen. We're not providing a concrete deliverable. We're offering possibility and the ability to really drive savings that you don't know even exist. That's why it's hidden. And that's why we describe the title of our webinar. The opportunity is certainly there, and the conversation is where you start.
And they're always free.
Yeah.
This is great. I mean, I didn't actually realize there was so much opportunity in both cases. So, and I realize we've only scratched the surface on different types of things, and you're looking for more conversation. So if anybody in the audience has any further questions or wants a deeper conversation, please reach out to Brad and Lindsay. And I want to thank Brad and Lindsay very much for sharing their knowledge and their experience with us today. Let's give them a virtual round of applause.
Thank you.
Yes. All right. Want to talk for a minute about Business Pros. Our group is organized to offer high quality educational content like today, and our 27 members are available to help business owners in just about any capacity. So if any of you have questions about the resources our group can provide, please contact me. We're putting together a slate of webinars. Today's was our 3rd in 6 weeks, and we'll be doing 2 per month for the rest of the year until all members have a chance to present on their topic. Our next webinar is 2 weeks from today, Wednesday, July 15th. It's the Employer's Dilemma, Practical Planning to Effectively Running Your Business Remotely. The target audience for this is going to be not only human resource people, but also business owners, small business owners that may not have a human resource department. And our panel will be discussing the irreversible movement towards a remote workforce, both from a human resources and a technology perspective. So that's 2 weeks from today, Wednesday, July 15th, save the date. I want to thank everybody in the audience. I appreciate you all taking your time out of your day to join us today. Thank you again, and make it a great day. And we'll talk to you, and we'll see you soon. Bye now. Lindsay, I've got to pop off. I've got another meeting to go to. So nice job. Well done.
I appreciate it very much. You ran it very well.
All right. Thank you now. Bye.
Bye now.